The fiscal cliff, we had some tax extenders out of the fiscal cliff. The mortgage cancellation relief was extended until January of next year. That's the law that governs taxation when somebody either forecloses, when a property is foreclosed upon and it's sold at tax sale. The difference in what the home sold for at the sheriff's sale and the amount that's owed on it, and I said tax sale, I meant sheriff's sale, excuse me, and the amount that's owed on it is considered taxable income that the borrower would have to pay taxes on normally. And this law said that they don't have to pay taxes on that, don't have to treat that as income and pay taxes on it. It also applies in short sale situations. The amount that the bank takes that's below the amount that's owed, that difference is taxable income and normally would be taxed except for this act. And it did expire at the end of last year. And so we had a couple of days before they extended it that we thought that might be a problem, but they did extend it for one more year. So we'll see what happens at the end of this. Deduction for mortgage premiums for filers making below 110 is extended to 2013, and it was made retroactive to cover 2012. The 50-year straight line cost recovery for qualified leasehold improvements on commercial properties were extended and made retroactive as well. 10% tax credit up to $500 for homeowners for energy improvements to existing homes was extended and then made retroactive. And permanent repeal of PEAS limitations for 99% taxpayers. I wasn't, how many of you guys are familiar with PEAS limitation? Oh, Rick. Rick knows all about PEAS limitations. Honestly, I wasn't tremendously familiar with this, but PEAS limitations reduce the amount a high-income taxpayer can take as an itemized deduction to the lesser of 3% of the AGI for deductions in excess of the threshold or 80% of the itemized deductions allowed for the year. It applies to individuals who make $250,000 or more, joint filers over $300,000. Gross income above thresholds is multiplied by 3% and used to reduce the value of the filer's itemized deductions. And the total amount of deductions cannot exceed 80%. If it hadn't been reinstated, then it would have applied to all filers starting at $174,000 opposed to the $250,000 and $300,000. So for more information on that, talk to your accountant or Rick, evidently. Capital gain stays at 15% for those in the top rate, $40,000 individual and $450,000 for joint. After that, any gains above those amounts will be taxed at 20%. The $250,000 and $500,000 exclusion for sale of principal residence remains in place. The estate tax, the first $5 million for individual and $10 million for family estates is now exempt. After that, the rate will be 40%. That's a nice chunk, isn't it? That's up from 35% in 2012. So if you've got more than $5 million in your estate, I would suggest you start spending some of that. Exemption amounts are indexed for inflation.